Joining us right now is one of our tech voices who's been buying NVIDIA on that dip. Wang is the Constellation Research founder and chairman. Good morning to you. Help us. You've been buying on the dip. What do you think it's worth today? I mean, right now we should say stocks across the board, but there's a little bit of a, I don't know if you want to call it a sell America situation, but this morning we've got a lot of things off, maybe 2% or so.
Well, in general, I mean, we've seen the recovery year to date and year over year with the Mag 7. And there's been a lot of, since the tariff situation, as we always say, we're a couple of tariff trade deals away from actually a recovery. The recovery is starting to happen. And so it's coming up on the up curve. And so when you take something like NVIDIA and their announcement on, a Taiwan supercomputer, you see the announcement as well in terms of what they're trying to do to get around export bans and making sure they build an export compliant chip. All those things are happening at once. And it's not just NVIDIA, it's just tech stocks in general. There's a recovery that has happened. And I think, as the more trade deals that do come through, the more likely we're going to see that recovery.
And when you look at like an Alphabet, though, or somebody else that maybe is, or a Microsoft, how do you think they react compared to like the chip makers, for example? How do you differentiate?
You're right. It's very different. Software is very different than chips. China-based companies like Tesla, Apple have a different kind of profile. And in terms of exposure, software companies typically don't have as much of the reliance on any kind of export control. So Microsoft, for example, and Alphabet and Amazon, Meta are less likely to feel that pinch. They also have different business models. Meta is heavy on advertising, Alphabet heavy on advertising. Even Amazon is now probably heavy on advertising that you probably wouldn't imagine. And so those things play a different role in terms of that recovery. But in general, I mean, it's tech that's been driving double-digit gains, and it's tech that's still possible to get that infinite scale that most other companies aren't able to do.
So who would you buy and who wouldn't you buy that sort of lands in AI land?
Well, Alphabet and Amazon are still about negative 12%, negative 6% year to date. And that shows there's potential for recovery. What's interesting about Alphabet is they're able to go from chip all the way to AI, and they've got the wide range. And if you look at the competition between language models, Gemini is doing really, really well. And every version of Gemini continues to show that Alphabet actually has a really superior position on AI. Amazon, on the other hand, is playing a different game. Amazon has pretty much, it's firing on all cylinders. It's able to deliver on ads and goods and services and memberships and subscriptions. And they're also able to deliver AI, but it's AI for Amazon as opposed to AI for AI's sake in general. And so those two are underperforming for the year to date, but definitely have a lot of upside.
And where are you putting Apple in that? You're putting them together?
Apple's different. Apple is, if you look at it, they're down 13% year to date. And Apple is trying to deliver on an AI strategy, and people are still waiting for Apple Intelligence. They're waiting to see what happens with the tariffs and how that impacts Apple. They're looking to see where the production is. But Apple's still very solid, but we're all waiting to see what that next big thing is going to be from Apple.
But when you say you're waiting, does that mean that you would buy it at this price, or you would wait for some kind of other catalyst? And then you'd be late.
I would wait for some other catalyst.
Or no? But you'd wait.
I would wait for some other catalyst, which is really a tariff situation, to change.